This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Triple header. All three major indexes close at new highs, and the investor optimism comes on the eve of the jobs report, one of the most important gauges of the U.S. economy.
Budget pain, why the White House proposed budget has some in the heartland growing concerned.
Sky high. Insurers want to assess hurricane damage and cut you checks more quickly, and they're going to new heights to do that. Those stories and more tonight on Nightly Business Report for this Thursday. It's already June the 1st. Good evening, everybody. I'm Bill Griffith in tonight for Tyler Matheson, coming you to this evening from the New York Stock Exchange. Good evening, Sue.
Good evening, Bill. I'm Sue Herrera. Welcome, everybody. Records were set on Wall Street today. The Dow, the S&P 500, and the NASDAQ all closed at levels they've never closed at before. And the investor optimism came on the eve, as Bill mentioned, of the employment report for May. So let's get to the numbers on this first trading day of June. The Dow Jones Industrial Average advanced 135 points to 21,144. The NASDAQ gained 48, and the S&P 500 rose 18.
And Wall Street's enthusiasm was due in part to the latest reports on the labor market. Private businesses added more than 250,000 jobs last month. That was well ahead of estimates. And payroll processor ADP said that the hiring primarily came from companies with fewer than 500 employees. It accounted for 3/4 of the jobs that were added in May. And tomorrow, of course, the government's monthly employment report will be released. Expectations for non-farm payrolls to be increased by about 184,000 and for the unemployment rate to remain steady at its 4.4% rate.
However, job cuts are coming to one well-known American company. General Motors will eliminate one of 2 shifts at a Michigan transmission plant. The automaker won't say how many workers are affected, but there are reports it could be roughly 300 positions.
And those job cuts come amid lackluster sales last month at most of the major automakers. In fact, it was the slowest pace we've seen in more than 2 years. But amid the unimpressive numbers, there were signs that may give investors hope that the auto industry can stay highly profitable even as sales slow. Phil LeBeau explains.
There was mixed news in America's showrooms last month. Let's start with the not-so-good news. Sales were unimpressive. Only Ford posted slightly positive results among the big 4 automakers. Once again, trucks and SUVs are driving demand, while car sales continue to slide, even with some models carrying huge incentives. As a result, May was the 3rd straight month with a sales pace under 17 million vehicles, the slowest 3-month period since 2014.
This is a cyclical business. Some cooling off was inevitable, and guess what? It's happening.
While automakers are wrestling with slower demand, they appear to be showing some discipline when it comes to incentives. That's the good news from last month. The amount of money spent to close a deal, even when you factor in big discounts for some slow-selling cars, was relatively flat compared to April. Meanwhile, automakers are expected to curb production as they head into summer, which would help ease bulging inventories. One other piece of good news for the auto industry is the overall health of the U.S. economy. The combination of low unemployment along with high consumer confidence should drive relatively strong sales as the industry heads into the summer. Phil LeBeau, Nightly Business Report, Chicago.
But one part of the automotive industry that's expected to see big growth is driverless cars. A new report today says it could be worth $7 trillion by the year 2050. That figure includes industries that will contribute to and be created by autonomous driving. The study adds that it's too soon to predict which companies are poised to grab the biggest share of that market. Bill?
Elsewhere, Sue, construction spending recorded its biggest decline in a year. Investment in both private and public projects fell in April. According to the Commerce Department, overall spending fell nearly 1.5% in that time.
The president will withdraw the United States from the Paris Climate Accord. In a speech in the White House Rose Garden, President Trump said the agreement was harming the economy.
The cost to the economy at this time would be close to $3 trillion in lost GDP and 6.5 million industrial jobs while households would have $7,000 less income, and in many cases, much worse than that.
The decision, though, goes against the advice of a number of executives from America's biggest corporations. That withdrawal process could take up to 4 years.
As you know, the White House recently released its proposed budget for the upcoming fiscal year. It includes sharp cuts in spending to our nation's heartland. And as Yilan Mui tells us now, one Kansas farmer is growing concerned.
Derek Sawyer's family has been farming in McPherson County, Kansas for 4 generations. They grow wheat, corn, and soybean, they raise cattle, and they even have horses. All that is possible, Sawyer says, because of the federal crop insurance program.
Crop insurance has always been a big part of what we do, more for the assurance that if we have a disaster, that it will help cover the cost of production. It's definitely not a program that we're going to get rich over.
But President Trump's latest budget axes agriculture programs. $28 billion from crop insurance, nearly $6 billion from conservation efforts, $650 million from direct subsidies to farmers. The grand total, $38 billion. White House Budget Director Mick Mulvaney agrees that crop insurance is critical to farmers, but he says that's exactly why they don't need a big subsidy to get them to buy it. He also recently told lawmakers that the administration is helping small-town America by rolling back regulations.
Farmers are farmers, and they want to grow stuff, and they want to be productive. They don't want to be paper pushers who try and figure out how the federal government is going to punish them for doing something that they thought was right.
Still, some Republicans are crying foul. Senator Pat Roberts of Kansas and Representative Michael Conaway of Texas oppose these cuts. They're the chairman of the 2 agriculture committees in Congress, and they've pledged to protect farmers' safety net.
This is amazing.
The president's budget is just the starting point for negotiation. Many farm states voted for Trump, and Sawyer said he's hopeful that means the White House will listen to people like him.
We knew there wasn't a perfect candidate, and honestly, there never really is. But what I believe in is smaller federal government, more local control, and fiscal responsibility. And, I feel that we can really work with the president through his new Secretary of Agriculture, Sonny Perdue.
Yet the administration has already disappointed some farmers on issues like trade and immigration. They're hoping that cutting crop insurance won't end up being the final straw. For Nightly Business Report, I'm Yilan Mui in Washington.
By the way, on our website, you can read more about farmers and the proposed budget. Just log on to nbr.com. Sue?
Bill, as we told you, the major indexes sit at all-time highs. And while you might feel good about your holdings, a recent report suggests that adding alternative investments to a traditional portfolio of stocks and bonds has historically increased returns while also reducing your risk. So what are some alternative types of investments you might want to consider? Time for a strategy session with Jeff Sout. He's Chief Investment Strategist at Raymond James. Jeff, good to see you as always. Welcome.
Oh, you bet, Sue. Thanks.
You say that one of the things that you're looking at to perhaps add to diversify a portfolio are certain commodities, because you say they're in the bottoming formation.
Yeah, if you look at the CRB index or the Goldman Sachs commodity index, it looks to us like they're trying to form a bottom here. It's probably best represented by energy. Energy is out of favor, and some of the stocks are off. In fact, some of the stocks are off 40–45% from their recent highs. And, I like to buy things that are out of favor because they tend to come back into favor.
You also like Mexico, Jeff. In fact, you like it more than China. Why?
Well, what's happened in China, the wages over the past 5 years have gone up 5-fold, and yet the Chinese workers are still disgruntled, and so the quality of some of the things they are producing has come down. I don't know if you saw this, Bill, but Foxconn, that was building the iPhones for Apple, is going to build a plant in the U.S. Mexico, I think, is going to be the new China. Their production standards are up to U.S. quality standards, and the transportation costs are a lot less, even if we do build the wall.
How would you do that? How would you play Mexico or any other country that you like around the globe?
I would use the exchange-traded funds to do it, or a Mexican-centric mutual fund. I think active management, I prefer that over passive management right here. Active managers have been outperforming for the past couple quarters. I think that's going to continue.
You know, I was just looking at the statistics. Since the election, the S&P is up about 13%, the Dow's up 15%, the NASDAQ up 16%, but you still think the U.S. is cheap. Make your case there, and where would you put money to work right now?
You have more high-growth, high-margin stocks in the S&P than ever by definition. That means you should have higher valuations than historic. You've got this change from tangible assets in the 80s to intangible assets on balance sheets. Currently, by definition, that means valuations should be higher. If you take out the aberrational low PEs in the 70s and 80s that occurred because double-digit inflation and double-digit interest rates, and start in 1990 and look at the PE at the beginning of each year up until this year, you find the average PE is 23.85. So we're trading at about 18 times this year's estimate. Every 1 point drop in the corporate tax rate adds $1.31 to that estimate.
On that note, Jeff, thank you, as always. Jeff South.
Always a pleasure, Sue.
With Raymond James. Bill?
All right, still ahead, assessing the damage, why the sky's the limit for property insurers.
It is June 1st, and that means it's the start of hurricane season. This year, the National Oceanic and Atmospheric Administration is predicting a 70% chance of 11 to 17 named storms in the Atlantic. Morgan Brennan is in Windsor, Connecticut, with an inside look at how the insurance industry is preparing.
Maybe we have damage to this roof, some another cause of loss. Maybe it's hail, maybe it's wind.
At Travelers Claim University, 7,500 adjusters come through each year. They learn how to assess property damage using 2 model homes inside a 110,000 square foot Hartford area facility.
Why did you choose these 2 model homes to use?
Really to reflect the differences in complexity of properties that we see all around the country.
Patrick Gee is Senior Vice President of Claims for Travelers.
This might be something that would be typical of tree damage.
But this year, there's something new to learn: drones. The company began using the technology in an official capacity last year, deploying drones to help assess damage from Hurricane Matthew.
It can take days off the process,
meaning checks can be cut more quickly for repairs. Travelers has 150 FAA-certified drone operators and hopes to have 700 by next year. And they're not alone. State Farm and Allstate both say they are working to expand their usage as well. But it's not just drones either.
During hurricane season, what does this room look like?
Well, if we have an event, this room is packed.
During a storm, the Catastrophe Response Center churns weather data, maps the locations of policyholders, even monitors social media, which provides instant analysis as events unfold on the ground.
We've been able to recreate a tornado path just based on the images that people put out on social media.
Travelers and other property casualty insurers say they prepare for the worst all year long, something the National Oceanic and Atmospheric Administration says is essential for everyone.
There is a potential for a lot of Atlantic storm activity this year. We cannot stop hurricanes, but again, we can prepare for them.
For Nightly Business Report, I'm Morgan Brennan in Windsor, Connecticut.
Communications equipment maker Ciena tops expectations, and that's where we begin tonight's market focus. The company reported profit and sales that rose, called the quarter, quote, outstanding. Ciena also sees this quarter's revenue coming in slightly higher than estimates. As a result, Ciena shares popped by more than 15% to $27.19. But clothing retailer Express missed revenue estimates despite seeing solid demand in its e-commerce business. The company also reported a wider than expected loss and same-store sales that did not impress analysts. Despite giving downbeat guidance for the year, Express said that it is confident it is taking the right steps to improve the company's performance. But investors weren't buying it today. Shares plunged by 19% to $6.27. A rise in customer spending helped results at Dollar General, though. The discount chain saw revenue increase thanks to improving same-store sales. Profit was also ahead of street targets, and the company said that it has the right strategy in place to bring more shoppers into the store. dollar. General shares rose more than 6.5% today to $78.19.
Machinery maker Deere said it is buying Germany's Wirtgen Group for nearly $5 billion. Deere said the deal will expand its current construction equipment portfolio and also grow its footprint as it takes on a larger customer base. Deere shares were up nearly 2% to $124.70. The athletic apparel company Lululemon reported a rise in earnings which topped forecasts. Same-store sales edged lower, but the results were still better than what Wall Street were looking for. The company also sees revenue for the current quarter above estimates. Shares initially shot up in after-hours trading, and they ended the regular session up just a fraction to $48.67. And home furnishings retailer RH, formerly known as Restoration Hardware, beat sales expectations while its earnings were in line. The company raised its sales guidance for the year but slashed its profit outlook, saying it remains cautious due to an uncertain environment and planned investments. Shares initially got crushed in after-hours trading, losing about a quarter of their value and erasing an earlier 2% gain when the stock closed at $57.25.
Well, despite today's robust ADP report we told you about earlier and Wall Street's high expectations for the big jobs report coming out tomorrow, there is still some concern and doubt about the lack of skilled workers in our country. Ben Castleman is chief economics writer for 538.com. He says the so-called skills gap is a myth. But Nariman Baravesh believes the lack of skilled workers is a real challenge for businesses. He's chief economist at IHS Markit. Good to see you both. Thanks for joining us today.
Thanks for having me.
Ben, what do you mean, a myth? I mean, the theory is that there are oftentimes just not enough skilled workers to meet the supply that's out there for many of the companies out there. You disagree with that. Why?
Yeah, I mean, look, I hear this from CEOs and from executives all the time, and I don't doubt that on an individual level, if you're a company, you're trying to hire somebody, I'm trying to hire, it's tough to find people, right? But in terms of sort of looking across the economy, is there a shortage of people that is somehow holding back the economy, that is making it hard for us to reach our potential? I don't see the evidence, and the best evidence I can point to there is look at wages. You just don't see the kind of wage growth we would think we'd see if people couldn't find good workers.
Nariman, you do think that there's a skills gap, so take the other side of that argument.
Well, let's look at soft data and let's look at some hard data. I mean, a lot of businesses and business surveys, whether it's IHS Markit or the Institute for Supply Management or the National Federation of Independent Businesses, they're all saying the skills shortages or shortages of skilled workers is one of the top 2 or 3 sort of challenges. And by most estimates, something like 40% of businesses are saying they can't find enough skilled workers. So I have to believe in those numbers. I can't just dismiss them and say, well, you know, what are they talking about? This is pervasive. Let's look at some of the hard numbers. I mean, Ben raised the wage question. If you look at the Atlanta Federal Reserve wage tracker, high educated wage earners are earning, their wage increases are about 4% a year, whereas low educated workers, their wage increases are growing by 3% a year. So that suggests that there's a problem here in terms of just the growth in wages, forget the levels. So I think there is a skills shortage, and a lot of the hard data sort of point to that, including the unemployment rates. Unemployment rates of people with a college education, 2.4%. Unemployment rates of people without even a high school degree, 6.5%. That tells you something.
Ben?
Yeah, although, I mean, the gap in the unemployment rates has not been widening. In fact, if anything, it's been narrowing. And if anything, we're seeing an economy that's starting to put people back to work. I mean, I think that it's important to distinguish here between a skills gap and an economy that is doing better, or a labor market that is doing better. Is it harder for companies to hire now than it was when the unemployment rate was at 8%, 9%, 10%? Absolutely, and we should be glad that it's harder for them to hire, because that's when you start to see a bit of wage growth. But, you know, I drilled down on a few of the specific occupations that I'm always hearing are difficult to fill, whether that's at the higher end where you're talking about software engineers and developers, or at the skilled trades that I hear a lot about, electricians and welders. None of those show the kind of really strong, aggressive wage growth that you would expect to see if companies were really struggling to fill positions.
But Nariman, I think you would point to the competition to get the H-1B visas as an indication that highly skilled workers are being sought after, and they're not being filled here in the United States necessarily.
Absolutely. And I know there's a lot of controversy around that program, and it's been abused, and I won't deny any of that. But nevertheless, the fact that these visas get snapped up basically within a day suggests that, in fact, companies are desperate. Maybe that's too strong a word, but really need high skill, especially the high-tech workers. Now, in terms of conversations I have with CEOs of companies, they don't complain that they don't have enough landscapers. They do complain that they don't have enough engineers. So, again, that's anecdotal information, but it's there. And so we hear it all the time.
I mean, look, I'm going to go after this and watch the NBA Finals, right? I wish LeBron James were on my team. I think everybody wishes LeBron James were on their team. That doesn't mean there's a shortage of 6'8" forwards, right? It means that he's a singular talent, and people with particular skills, there's always a demand for them. They're always going to get paid accordingly. But a shortage is, we can't get enough NBA players to put a good product on the court. We can't, grow the league. That's what I don't think we're seeing, is the kind of shortages that are actually holding back the economy in any meaningful way.
All right, tell that to my Los Angeles Lakers, but that's for another discussion. Ben Castleman, thank you. Nariman Baravesh, always good to see you. Thank you for joining us tonight.
Thank you.
Speaking of the NBA, coming up, it's game time. The newest Silicon Valley players are on the court and in the boardroom. Two well-known retailers are closing more stores. Payless will shut about 800 locations in total as its bankruptcy reorganization moves forward. Separately, Radio Shack has closed more than 1,000 stores just since Memorial Day weekend. Back in March, its parent company proposed closing just 200. At its peak, the electronics retailer had more than 7,000 storefronts and claimed it had a location within 3 miles of 95% of all American households.
And Uber lost more than $700 million in the first quarter. Now, that's a lot of money, but it's actually narrower than the loss it claimed for the final 3 months of last year. The ride-hailing company also reported a rise in revenue, and the company says it is on the path to profitability. But it wasn't all positive. Uber's head of finance is leaving, becoming just the latest in a number of high-profile executive departures there.
As Bill knows very well, this is one of the most intense rivalries in basketball. For the third straight season, the Golden State Warriors will take on the Cleveland Cavaliers in the NBA Finals. And for the Warriors, it's their work off the court that is really paying off. Josh Lipton is at the Oracle Arena.
The Golden State Warriors are one of the best teams in basketball, and the team is different from any other in sports. It holds a distinct advantage. Some of the stars are dedicated tech investors with a direct line to the most influential people in Silicon Valley. Newcomer Kevin Durant invests in things like an app to help low-income Americans manage their benefits to food delivery startups. Andre Iguodala, who holds stakes in an electronic trading platform and health and wellness companies. Not only does he invest, but he tries to educate other players on the value of investing.
We're doing a crash course in the tech industry, and NBA players were directly involved with the tech world, whether we know it or not.
And Steph Curry invests in CoachUp, which connects athletes with a network of local coaches. He also co-founded a small company that sells marketing software called Slice, whose CEO says Curry is an invaluable recruiting tool in Silicon Valley.
The fact that Steph comes into our office space every once in a while, or that we get to go to a game and talk to him afterwards, is not something that any other startup is able to do.
The benefits can be mutual. Players create portfolios of investments that could generate returns long after they retire. Startups get help from global superstars to promote and build their brands. The Warriors' roots run deep in Silicon Valley. Joe Lacob, who bought the Warriors in 2010, is a veteran venture capitalist from Kleiner Perkins. He partnered with entertainment mogul Peter Guber and formed an ownership group that includes YouTube co-founder Chad Hurley and venture investor Chamath Palihapitiya. The Warriors' Draymond Green says that's who he looks to for investment advice.
One of my mentors on the investing side is Chamath. He's amazing. He teaches me about so many deals, and it's not more even about investing, but just, learning, and then all of a sudden you can kind of see trends and, which companies are doing well, which companies aren't doing so well.
Professional athletes have long invested their millions in areas like real estate to build their savings for life after basketball. But industry experts say today's younger players tend to be more sophisticated and personally involved with their investments. In addition to money and prestige, famous players bring some pretty attractive perks to young startups. For example, Bryant Barr of Slice will be at the game here tonight along with his parents, courtesy of his friend and co-founder, Steph Curry. For Nightly Business Report, I'm Josh Lipton, Oakland, California.
Love that story. That's right up your alley, Bill.
Absolutely. Should be a great series. Looking forward to it very much.
All right, that does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.